Reports of a big Tesla decision in China suggest that there is more trouble ahead for the world's leading EV maker. Tesla shares moved lower on Friday, extending its run as the worst performing stock on the S&P 500 index, as the car maker continues to face challenges in its most important market. Tesla shares have shed more than $240 billion in value this year, as investors count the cost of its strategy to win market share, while sacrificing profits and assess the impact of fading EV demand in the key market around the world. Tesla itself warned investors in Jan that the vehicle delivery growth rates would be notably lower than 2023 levels, and while CEO Elon Musk said that the profit margins would improve only on the back of central bank interest rate cuts. Tesla's profit margins, probably the most closely tracked metric by analysts on Wall Street, narrowed to 17.6% over the 3 months ended in December, down from a 23.8% margin over the year earlier period, and weaker than expected sales figures from China, where volumes fell to the lowest levels in more than a year last month, are also adding to the overall pressure on Tesla's aggressive delivery targets. And the Wells Fargo analyst Colin, in fact, forecasts negative sales growth for next year and flat volumes this year, as well as the possible loss of the luxury brand premium for the whole group as well. And when it comes to the Tesla's China challenge, Tesla is also facing a huge wave of competition in China, its biggest and most important market, where sales over the first 2 months of 2024 went up by only 6.8% from a year earlier. And Chinese car companies are the most competitive car companies in the world, Elon Musk told investors in Jan. I think they will have a significant success outside of China, depending on what kind of tariffs and trade barriers are being established. And frankly, I think if there are not many trade barriers established, they will pretty much demolish most other companies in the world. And that's led to what Bloomberg News has reported to be a trimming of production at its Shanghai factory, with shifts for the Model Y midsize SUV and Model 3 sedan pared back to 5 days per week from the usual pace of around 6.5 days. And CFRA analyst Garrett Nelson noted that the high fixed cost nature of auto manufacturing continues to pressure Tesla's profit margin, but he also added that declining battery cost could be a silver lining for the beaten down shares. And the good news is that the stock appears to have largely priced in these concerns, and we see catalyst on the horizon with the likely unveiling of its next generation EV model and Roadster later this year, said Nelson. And additionally, Tesla should benefit from less competition as traditional automakers moderate their EV. Something very interesting. Cathie Wood's ARK ETFs have made significant moves in the stock market on Friday, March 22, 2024, with a series of buys and sells that reflect the investment firm's shifting strategies. And the most noteworthy trade of the day was ARK's sale of Coinbase Global, with a total of 217,000 shares offloaded across the 3 ETFs, amounting to a substantial $57 million in value. And on the buying side, ARK showed a strong appetite for Tesla, purchasing 100,000 shares valued at $20 million. And this move underscores ARK's continued confidence in the EV giant, a stock that has been a long-standing component of Cathie Wood's innovative-driven portfolio. And another significant trade was the acquisition of 305,000 shares of Roku, which had a total dollar value of $19 million. And this purchase indicates a bullish stance on the streaming device company despite the competitive pressure that it faces. And Meta Platform has also caught ARK's attention, with the firm buying 24,000 shares across its ETFs, totaling $12 million in value. And this investment suggests that ARK sees potential in the social media conglomerate's ability to navigate the current tech landscape. And in terms of sales, ARK divested from DraftKings, shedding 134,000 shares for a total of $6.4 million, and from Robinhood Markets, selling 300,000 shares with a combined value of $6 million. And these sales could signal ARK's assessment of the risk or headwinds facing these companies. And the daily trade report also highlighted ARK's purchase of shares in several biotech and genomic companies, including 264,000 shares of Ceros Group and 98,000 shares of Intellia Therapeutics, reflecting a continued focus on the healthcare sector. And ARK's trading pattern over the past 1 week shows a consistent interest in certain stocks. For instance, Cathie Wood has been steadily increasing its stake in Cirrus Corp, suggesting a strategic accumulation of shares in the biomedical product company. And now when it comes to Tesla, for years Tesla has been among the top growth stocks, especially for many retail investors. However, 2024 has not been a good year for Tesla investors. It is the worst performing S&P 500 index stock on a year-to-date basis, with its price action looking like a mirror opposite of 2023 when the shares more than doubled. And Tesla is also the worst performing stock among the elite Magnificent 7 group, and many analysts are now questioning its growth story, with Wells Fargo analyst Colin arguing that it is a growth company with no growth. And in Friday's session, Tesla stock pulled back again on reports of lowered production at its plant in China. So how long can Tesla stock actually go amid a tarnished growth story? So let's take a closer look. And what happened to the Tesla growth story? Way back in its Q4 2020 earnings call, and Tesla touted a long-term delivery of yearly annual growth of 50%, with CEO Elon Musk stressing that we don't think we can maintain a growth rate in excess of 50% per year for many years to come. And the company's deliveries did rise by over 50% in 2021 as Tesla has predicted, and it was up 87% to be precise, but in 2022, its delivery growth slowed to around 40%, and last year, Tesla's deliveries went up by 38%, and Elon Musk effectively withdrew the 50% average growth guidance.